Well, good morning, good afternoon, everyone. My name is Matthew Wilson from CME, and welcome to another CME BDO Manufacturing Fundamentals webinar. In the past, we have covered a wide range of topics, including technology adoption, ESG, and supporting companies' transition to net zero. Today's topic is one that CME and BDO have spoken about doing for some time, and I am excited to be part of this session on buying and selling manufacturing operations in Canada. Today, you'll hear and learn from several experts at BDO about what you need to consider if you're looking to buy or sell in today's market. And to help set the stage for that, I'll provide a bit of economic context and provide the framework on why the timing for this session is ideal. Next slide, please. My name is Matthew Wilson, as I mentioned, and I'm CME's Senior Vice President. Next slide, please. For those who don't know us, CME is Canada's oldest and most influential industrial association. We are a member-based organization that represents a majority of the industrial output of the country, and we have offices and staff from coast to coast. Our purpose is to drive Canadian prosperity through a thriving manufacturing and exporting sector. We do this by providing support for the critical issues impacting manufacturing operations across the country. External to the company, we advocate with governments and to the public for better regulatory policy and programs to support investment and growth. And internal to companies, we provide strategic advice and training to improve all aspects of your operations, including productivity, health and safety, executive coaching, and of course, strategic intelligence, such as this webinar. Next slide, please. As you know, manufacturing is always in a state of flux and in Canada and around the world. Today, there are over 90,000 domestic manufacturers are constantly adjusting to the pressure of competition, customer demands, shifting markets, government regulations, and so on. That flux, along with a wide range of personal realities and other business factors, creates constant pressure and opportunities for buying and selling manufacturing operations. As we continue to put COVID further in the rearview mirror, the economics appear to be creating an ideal situation for more mergers and acquisitions in our sector. And three key factors are driving this belief. Revenues have stabilized, but profits remain under pressure. Overall income statements are relatively healthy, and maybe most important, cash on hand is at a 20-year high. And I'll quickly show some data to point this up. Next slide, please. First, though, some recent data has been released from Stats Canada that supports CME's belief and shows us that the real opportunity is today. According to them, roughly 5.6% of all businesses in Canada are looking to transfer ownership over the next 12 months. And for manufacturers, it's 4.7%. Well, we don't have a breakdown by company size or sector. Based on the number of manufacturers in the country, this means that roughly 4,000 manufacturers will be looking to sell or transition their company within the next 12 months. Next slide, please. As this slide shows, profit margins are still under pressure. Despite a sharp rebound post-COVID, manufacturing profits continue to trail the non-financial profit margins in the Canadian business sector. This is largely due to continued uncertain markets and rising output costs, as the next slide shows. Next slide, please. So while profit margins have declined overall, revenues continue to increase, and overall net incomes have just hit the third highest levels over the last 20 years in the manufacturing sector. Next slide, please. And this improvement in financial performance is demonstrated in the overall balance sheet for Canadian manufacturers, which is sitting at record highs, clearing a collective $600 billion last year. Next slide, please. And not surprisingly, as balance sheets continue to improve, cash on hand has improved as well, stabilizing above $80 billion in the manufacturing sector over the last few years. While this collective data as a whole for the sector, and each company will be different in a different situation, it is clear the overall state of the sector has stabilized post-COVID, and companies are now in a better position to either buy competitors to expand their business or exit the business altogether. It is CME's clear desire, based on our purpose, to help those companies find partners who will continue to invest and grow in their Canadian operations and to maximize the amount people get when selling their businesses. And this is where our friends at BDO come in. BDO has been a long-term partner in providing strategic business advice to CME members, and we are pleased to have them partner with us once again on this critical topic. Thank you to the whole team at BDO for your support of CME and our members' business ambitions. And I'm pleased to turn the stage over to Michael Morrow, who will introduce the BDO team and get into the meat of today's webinars. But one last comment before I turn it to you, Michael. Well, the cameras and mics are turned off for participants. We encourage direct participation. There's a Q&A text box. Please ask any questions as the webinar goes along. The panelists will either answer those questions as they see fit, or maybe the answers will come up in their comments, or I will make note of them and ask them in a moderated Q&A to the panelists a little bit later on. So thank you again for joining us today. Please enjoy the webinar. And Michael, my pleasure to turn it over to you. Thanks again to you and the team.
Great. Thanks, Matthew. Delighted to be here. Thanks for taking time out of your busy schedules to learn a little bit more about M&A and our team. I lead our M&A practice in Canada, so helping businesses buy and sell other businesses, as well as helping them to raise capital. I had the pleasure of introducing our team today. Brian Trainer is a managing director in our M&A practice who's going to be speaking about the M&A process and a checklist of things to think about as in advance of selling your business. Jesus is a partner in our strategy and value creation business. He's going to be speaking about ways to increase the value of your business in advance of a sale and increase its marketability. Alex is a director in our M&A practice and will be speaking about the buyer universe. In my introductory section, I'm going to be building on some of the themes that Matthew talked about, talking about some macro trends that we see will be fundamentally reshaping the Canadian economy over the next number of years, and then giving some predictions around the M&A environment going forward. So the first big macro trend that Matthew alluded to is this big wealth transfer that's happening in the Canadian economy. The Financial Post put out an article the other year saying that 3 out of 4 small and medium businesses are looking to sell over the next decade, representing about $2 trillion of value of transfer within the business owner environment. This is corroborated with our own polling with our own client base in Canada, where 76% of our respondents last year said that they look to sell their business over the next 10 years. And so if you think about that transition of number of businesses, including how that happens and where those businesses ultimately land in terms of ownership, will fundamentally change the landscape of Canada, because we are primarily a mid-market economy with driven by a lot of small and medium-sized businesses. On this next page, we highlight the activity of M&A volume in Canada on the left chart. It's been a real roller coaster ride of activity, and anyone in the business has experienced that. As you can see, in 2000, there was a sharp decline in M&A activity. And then following interest rate decreases, increased liquidity in the market, and a rebound in growth, we saw activity rebound drastically to record levels in 2021. And then as soon as we started increasing interest rates around the world, activity slowly dropped off, where it's troughed in late 2023. We expect going forward that this trend has reversed and will continue to reverse, particularly now that we're in a new cycle of lower and decreasing interest rates. We expect that downward trend to follow the same slope on the upward side, whereby by 2025, where again we have a confluence of cheaper capital, a lot of available capital, rebounding growth, we expect that we'll be back to record M&A volumes in Canada, and in particular because, as we mentioned, a number of sellers need and will come to market in the next number of years. The other big theme that we'll talk a little bit about is private capital and private equity. The amount of private equity capital that's been raised over the last number of years and continues to sit on the sideline is at a record level, over $2 trillion globally. That's all looking for great investments in homes, and Canada still represents a relatively safe and good place to invest. And so Canada will get its fair share of that capital coming into our markets to facilitate some of these business transitions that we've talked about. On the chart here on the left, we've outlined Canadian M&A activity for private equity. It's followed the same trends as the prior page. Again, we expect this trend to reverse and increase over the years with the market. What is interesting and really relevant for the businesses on this call today is that private equity generally likes old economy investments, and in particular, manufacturing and industrials. And so you see on the chart on the right, industrials and manufacturing leads activity with 145 deals last year. That represents about 20% of the volume. It's consistent in prior years. And so as the M&A market picks up, we continue to believe that private equity will take its fair share of acquisitions in manufacturing and industrials going forward. Next slide. Sorry, just go back and apologies. So yeah, the private equity environment in Canada is another big macro trend. It's going to reface and reshape the economy in Canada in terms of ownership. If we look at the trends globally and where private equity is played, private equity now represents about 50% of ownership of businesses in the UK for small and medium-sized businesses. In the US, that trend is following the UK, although it's a few years behind. Currently, the US economic landscape is owned by about 30% private equity. In Canada, it's roughly 10 to 12. So we're behind, but we expect that those trends will continue in Canada. A number of you probably are getting called by US-based private equity, trying to invest capital in Canada and looking for homes, and we certainly expect that trend to continue. We'll certainly talk a little bit more about private equity in that buyer use universe as part of Alex's discussion, but something to think about in the context of M&A, and certainly, again, a big macro trend that will reface the Canadian economy over the next decade. So with that, I'll turn it over to Brian Traynor, who will lead you through the M&A process as well as our checklist.
Thank you, Michael. I'm just going to adjust my screen here. And if we can go on to the first slide. Thanks, everyone. So I'll be presenting an overview of BDO's M&A process. There's a lot of information in some of these slides, and I'm not going to try to cover every point, but I will try to address sort of the key concepts and important themes. So before we get into our process, there's a couple of points I want to make, which are sort of fundamental, and they underpin what we try to accomplish when we sell a business. And the first is that we're going to run a confidential process. We're not going to interact with buyers unless client approves. And when we interact with that buyer, it's going to be under an NDA. And we're going to do that in a very phased, controlled manner so that only the information that really needs to be shared with the buyer as we move through the process is shared with them to protect the client. And I think the second point I'd like to make that's very fundamental is that we don't market with a price. We're running the process to get to a limited auction or conditions around a limited auction, and then we're soliciting offers. Jesus will be coming on later and talking about valuation. It's a very important topic in M&A, but when we actually market a business, we're not marketing with price. So having said that, we're going to talk about the process in a little more detail. So when we think about the process, we think about it in three distinct phases that are presented here in the slide. There's the first phase, which is preparation, the second phase, which is marketing and outreach to the buyers, and then the third phase is the actual limited auction, diligence, and closing. I'm going to take a moment and talk about each of these phases. But before I do that, wanted to make underscore one other important point. Before we would start to actually prepare and market a business and engage with the client to do so, we would do a lot of our own diligence in advance of that engagement with the client, not only to get to know them and understand the business, but to understand the appropriate strategy and goals that we're looking to try to align with our strategy and taking the business to market. And then we're going to, of course, talk about value. While I just said that we don't market with a price, we want to make sure that we have a good understanding on what expectations are so that there aren't any surprises when we get into the market in terms of preparing the client for the kinds of offers we think we're going to see. And then with any private business where there's usually an owner operator leading that business, transition is a fundamental point that needs to be thought through, talked through, and understood. And there needs to be an understanding between the client and the advisor before any type of engagement can be undertaken. So we will have those pre-engagement discussions, and when we have an understanding and alignment, we will engage, and then we will enter the first phase, which is the preparation. So just going to take a minute and talk about this. During the preparation phase, we're initially gathering a lot of financial and business information to try to understand the business, things like the customer base. We're looking at data there, the organization that's supporting the business, key employees, if there are other attributes to the business that need to be understood around strategy or special supplier relationships or special customer relationships, all of that is covered. And then that information is processed and it's captured in a document we refer to as a confidential information memorandum. So this is one of the key deliverables, if you will, of the preparation stage, is to prepare that marketing document. And then the second item that we're spending a lot of time on is the buyer list, which of course is critical to the marketing phase and making sure that we're identifying and reaching out to all of the logical parties. Alex Stern will be coming on a little later to talk about buyers, so I'm not going to spend much time on it now. But that would all be prepared in advance of the marketing. And then the buyer list and the confidential information memorandum are presented to the client. They're vetted, refined, and finally approved before we would start any marketing. That takes us into the, and that just from a timing standpoint, those preparations typically take 1 to 2 months. Sometimes they'll take a little longer. It really depends on how quickly the client can respond with information and considerations like that. But generally we benchmark about 2 months to properly prepare. The next phase is the marketing. This is where we conduct the outreach to the buyers that we have identified and have been approved by the client. We go to all of the buyers that are identified, typically at once in a synchronized process. As I said earlier, we engage with those buyers under a non-disclosure agreement. And then there are multiple rounds of follow-up once the confidential information memorandum is distributed, and it's only distributed to parties that sign an NDA. There are multiple rounds of follow-up to determine where the serious interest is. And once we've determined where that serious interest is, those parties are invited into the limited auction process, which I'm going to describe in a minute. So that marketing phase, you can benchmark typically 3 months to get to that from that large list of buyers to a short list of buyers that you're going to bring into your auction. And then in the final phase, the limited auction, diligence, and closing, we typically think about bidding in 2 rounds. So there would be an initial round of bids, which we would refer to as an expression of interest. This is a high-level preliminary offer that we would request any party that had come back to us during the marketing and indicated they wanted to take a serious look at the business. We'd ask them to submit that, and it would cover, important deal points such as price, structure, preliminary thoughts on transition. If there was real estate involved in the deal, are we buying that real estate, or are we looking at a lease? Those preliminary offers are used to, and we evaluate those with our client to determine who we're going to have meetings with. Once we've done that evaluation, we move on to the meeting phase. We don't necessarily meet with every party that submits a proposal. It's a little bit of a way of separating the tire kickers from the serious parties at that stage. I'm involved in a process now. We have 7 preliminary offers. We're probably going to take 3 or 4 meetings tops. And then I guess final point, at this stage, there probably wouldn't be a lot of negotiation around these expressions of interest. If there was a party that was well off the mark on value, we might go back and discuss that with them if there were other things that we liked about the buyer and there was a disappointment on that point. But typically, we're not negotiating those expressions of interest before we enter the management meetings. The meetings then are conducted once we determine who we want to meet with. These are very critical to the process. This is the opportunity for the buyer and the seller to sit down and meet and have a very detailed discussion about the business. It's an opportunity for BDO and the client to get the buyer really excited about the business and moving forward with an LOI. And then coming out of those meetings, we would then ask for letters of intent. And this is where there would be much more serious discussion and negotiation around what those deal terms would look like in the LOI. And then we would ask for final submissions of those LOIs. There would be further evaluation, likely more negotiations. And then we would come to a point where we have to make a decision who we wanted to lock up with. So those letters of intent would all have one thing in common. They would have an exclusivity period identified in them. It's typically a 90 to 120-day period for buyer to complete their due diligence and close the transaction. And when we decided which party we wanted to move forward with, we would execute the LOI, we would lock up, and then discussions with all of the parties would cease through that exclusivity period. If the LOI is done properly and we've negotiated all of the business points, then it's going to make the confirmatory diligence run much smoother, and then negotiation of the final share purchase agreement shouldn't be too difficult to then get onto a closing. And we typically benchmark that LOI management meeting, EOI management meeting, LOI diligence and closing phase to be probably a 4, perhaps a 5-month process. We have a 3 to 4 month process here. That's not untypical, but it's typically 4, maybe 5 months. So overall, the process, if you want to benchmark timing, you're probably looking at 9 to 12 months to complete a transaction. That can certainly happen in a shorter period of time, depending on how the marketing goes. It can sometimes take a little longer, and meeting schedules and things like that. Availability of information can add a little more time to the process as well. Niven, you want to go to the next slide? So this slide really encapsulates what I've been talking about. It's our philosophy around marketing and business, which is to get in front of all of the logical parties at the same time, market to them in a synchronized manner, do it in a very confidential, with a very confidential approach. So there's not going to be any interaction with any buyers unless client approves it. The information those buyers receive will be approved by client, and those buyers will not receive that information until an NDA is signed. And then think about, maybe a buyer list with, I don't know, a typical buyer list might have 100 or 150 industry and private equity groups. If we're going to make sense to go both types of or both categories of buyers. Through the follow-up, we then end up with 10 parties that are expressing interest in participating in the auction. We ask for those EOIs. When those are received, perhaps we're then selecting 4 or 5 of the best candidates to have meetings with, and then we take them through to the LOI. And that's the objective of the process, is to have multiple discussions with all of the logical parties in a reasonable amount of time to identify the most motivated parties to negotiate with. You identify those motivated buyers, and you will end up with a much better proposal and a much cleaner diligence process than if you try to deal with these buyers on a one-off basis. So we're moving on now to the checklist. I'm going to talk about, we have six items on our checklist. Not going to spend a lot of time on value enhancement because Jesus is going to come in and talk about this, but this is a very important consideration for anyone who's contemplating a sale of a business. And I'd also point out the first 3 items to your value enhancement, looking at your information system and the tax planning. These are sort of longer term projects, so you should be thinking about these, 2 to 3 years in advance. Certainly when it comes to the tax planning, if you want to put trusts and things like that in place, you're going to need 2 years to allow that to mature so that you can have access to the additional capital gains exemption that that type of planning will facilitate. But value enhancement it's about looking at your business with an advisor critically to figure out how you can increase value and operate that business more efficiently and optimally to drive more value in the business when you sell it. And as I said, Jesus is going to talk about that. The information system you're operating, it's critical to managing your business. It's also critical to selling a business. And if the system isn't being fully utilized, or if it's a bit old and it's time for an update, we really encourage our clients to look at that before we get in the market, because if there's one thing that often slows us down and then can create frustrations for the client, is that there's information that's being requested by the buyers when you get into diligence, and they just can't provide it because their information system hasn't been tracking that information, or they don't have the ability to do the reporting that is required. And then on tax planning, this is critical in terms of optimizing after-tax profits. There's been, of course, recent changes to the budget with the change in inclusion rates and capital gains, but which was a disappointment, and it's going to lower after-tax proceeds that can't be sheltered through the use of exemptions. But they have not. Actually, what they did was they increased the exemption significantly from about $1 million to $1.25 million, and there are strategies out there that are very legitimate that we can still utilize to multiply those exemptions. And I would encourage anybody who's thinking about a sale to talk to their tax preparer about this, because this is something that has to be done 2 years before you sell a business or you close. So it doesn't have to actually begin 2 years before you start a marketing process, but by the time you get to closing, you need to have that structure in place for 2 years to access those additional lifetime capital gains exemptions. And there is that consideration, and then other tax planning ideas that you might want to talk to your advisor about, and that needs to be done well in advance of moving ahead with a sales process. Then Nipun will go to the next slide. Valuation, very important subject. We're going to talk about it with our clients before we engage. It's probably worthwhile to maybe look at an independent valuation. Jesus is going to talk about valuation in the value creation section he's going to go over, so I won't spend any more time on that. But legal diligence, you want to make sure that your corporate records and things like that are up to date. If you had partners in your business that you have bought out, you are going to want to make sure that all of that documentation is in place before you sell the business. And then there are other special situations like that that you're going to want to talk to your legal counsel about. Make sure that the paper trail is there so that when we get into diligence, there's not any scrambling around to try to prove that, for example, that you own the business. And I'm thinking of a specific situation I found myself in with, where a seller had bought out 9 partners over 15 years to consolidate 100% ownership in the business. And when we got into the diligence, he could only, he had maybe half of the actual purchase documents where he could demonstrate he had bought out his partners. We got through it. We actually got the deal completed, but at the time it added more time, and it created a little more complexity in sorting out the reps and warranties around this issue. And it's something that probably should have been identified before we got into the marketing so that we could have got this cleaned up. So you want to look at legal diligence as part of your preparations to market for sure. And then finally, choosing the right advisor. You're going to want to think about the track record of the advisor, their industry experience. You're going to want to make sure that that advisor has the capacity to take the business to market and is not overloaded with too many other projects. And you want to make sure that that advisor has access to the right relationships to make sure that you get to the right result when you're actually marketing the business. Okay, Nipun, to keep us on our timeline, I'll quickly go through this final slide, which is a summary of success factors. This is probably the largest single transaction any business owner is going to make in their lifetime, and usually, retirement is a key consideration. So you want to make sure that you're making the right decision from an advisory standpoint. You want to make sure that you're well prepared to go to market. You want to make sure that the advisor that you're using has got the resources to prepare properly. And then you want to do all of those things because once you're in the deal process, you want it to move through thoroughly but smoothly in the kind of timeline that I talked about. And if you don't do that, what happens is fatigue sets in. Client fatigue, advisory fatigue, and then we've got deal fatigue. And if there's one thing that can kill a deal, it's deal fatigue. And we don't want to avoid that. So this is why the preparations, anything you can do before you engage with your advisor, and then the preparations in getting ready to go to market are so critical. We really believe in thoroughly preparing, and then that will support us in the final stages of trying to close a transaction when we're into supporting legal counsel in the final negotiation of the share purchase agreement. We often get questions when we do these kinds of presentations around the economics of how we engage. So we've got a couple of points here addressing that. We typically work on a work fee and a success fee basis. So what does that mean? Most of the fee that we would receive, we'll receive when the deal is closed. It is calculated typically as a percentage of the total value of the deal. That percentage will depend on the complexity of the company, the size of the company, the industry, and other factors that have to be considered in the strategy that we're going to be trying to execute with the client. And then there would be a small work fee paid at the beginning of the engagement. That would be typically paid out over a number of months during the initial phases of the engagement. And then that work fee would be offset against the success fee when we close. I guess final point before we move on, and I hand things over to Alex Stern. This presentation will be available to all the participants after we're finished. And we in the fall at BDO usually put on in-person M&A seminars. And I think that we'll also be distributing some information on those seminars after the presentation is made available. And if there's any interest in attending a seminar like that, our contact information is also available in the presentation. We'd be happy to talk to you about that. These will take place in October and December in Southern Ontario. So I'll turn it over to Alex.
Thanks, Brian. Hi, everyone. My name is Alex Stern. I'm a director on the M&A and Capital Markets team, and I'm going to spend a bit of time giving background on how we look at the universe of potential buyers for our clients. As we previously noted, identifying and making a good list of potential buyers when preparing to sell your business is an extremely important step in the M&A process. Making sure that you have a thorough and well thought out list means that we will be reaching out to all logical parties, and we're driving as much competitive tension as possible to get the best result for our client. So as you can see on this slide, when we think about buyers, we split the universe into two key buckets, being financial buyers and strategic buyers. And when we refer to strategic buyers on the right here, we're really talking about industry buyers. So competitors or related parties, related companies in the industry, either up or down the value chain. These are going to be operators, and they're looking to acquire and run our client's business. These industry buyers may be looking for a new product offering, a new geography, or they may be looking to buy out a competitor to gain market share or vertically integrate. Typically, a strategic buyer will look to acquire 100% of a business, and they're not looking for shareholders to retain a minority stake or stay involved long term, although they will want shareholders to remain involved to gradually transition out of the business. And when we are looking at potential industry buyers for our client, we want to focus on companies that have experience in M&A and have done transactions in the past. This shows to us that they have the ability to review and assess an opportunity, get the internal approval, and work with their lenders to secure financing and close a deal. We don't want to be spending time with industry buyers that we think may not have the ability or financial capacity to actually close a transaction. For strategic buyers, say M&A is a great pathway for them to grow their business. In today's economy with high competition, high costs, consolidation of players is a really viable path to grow. So we want to make sure that we're talking to industry buyers that have a really strong strategic fit with our client. When we refer to financial buyers on the left, you can see there are three subgroups, being PE firms or private equity firms, family offices, and search funds. So first one, private equity firms. These are companies that have raised capital from third-party investors, and they're looking to acquire businesses using debt, grow those businesses over a set period of time, and then sell those businesses and be able to return those profits to their investors. Given that they have capital from third parties, there will be set terms as to how they can invest, what types of businesses they can invest in, and how long they can hold on to these companies. Different private equity firms will have different focuses, whether that's a specific industry or a size of company or an early stage or mature business. But what's pretty consistent in our experience is that private equity firms want to partner with existing shareholders and with management. They want management to remain involved and keep a minority stake in the business. This way, the members of management are invested alongside private equity firms and their investors, and they have what's called skin in the game. And ultimately, management is a profit alongside other investors when the business is sold. Below that, we have family offices. Family offices will be similar to a private equity firm, but rather than investing the capital of third-party investors, they're investing the capital of high net worth individuals or families. They're looking to buy companies and hold on to them for the long term. Similar to a private equity firm, they do plan to buy with debt and grow those businesses. But given that they're not accountable to third-party investors, they'll typically have a long-term view, and they're looking to often hold businesses indefinitely. And similar to a private equity firm, they would like to partner with management, but they may be more open to buying 100% of a business and bringing in their own contacts to run a company. The third bucket on the bottom left would be search funds. So these are individuals who are conducting a formal search for a company to acquire and then run themselves as the operator. These search funds, the individuals typically invest their own capital alongside a number of third-party investors who are backing them, but they're only looking to buy one business, whereas the private equity firms and family offices are looking to acquire a portfolio of businesses and a diverse portfolio of businesses. Similar to a private equity firm, a search fund is investing capital from third parties, so they'll have requirements for the type of business or the size of business that they're looking to invest in, and they'll have a set timeline for how long they want to hold on to the company. So I've given a good amount of detail about, sorry, Nitin, can you go back? Thanks. I've given a good amount of detail around financial buyers here because they are a really relevant and real option to acquire businesses. As Michael mentioned earlier, they're a growing segment of buyers in Canada, and it's expected they'll become a larger portion of ownership of companies. And many of the business owners that we've worked with do end up selling to financial buyers. We highlighted that there are record levels of capital that need to be used to invest in businesses, and these financial buyers, specifically private equity firms, are not short of capital right now, and they know how to work effectively with banks to borrow and use debt to maximize their returns on investment. And all three groups of these financial buyers, as well as industry buyers, will typically use debt to buy a business. And in today's macroeconomic environment, we all know that interest rates are higher than they have been in recent years. It's harder to borrow capital today than it was just a few years ago. There's more bank review, more diligence required to get sign off from credit committees, as well as stricter terms and covenants. But that just emphasizes the importance of working with the right buyer. And who is the right buyer? That would be someone who's able to work with lenders to make sure that they can get banks comfortable with funding the deal. As a group, we're still seeing deals close. We see the market remain active, as Michael had talked about. But it's really important that, and we advise our client to go with a buyer that gives us comfort in their ability to be able to close a deal. Past experience is extremely important today, and banks really want to lend to parties that have a good track record and history of being able to repay their debts, which is why I mentioned we like looking at industry buyers with a history of M&A. On the next slide, I'll talk, and the slide after, I'll talk a bit about key criteria for buyers. So different buyers, of course, will have different criteria, different risk tolerances, different goals, whether it's a short, a medium, or a long-term view for holding a company. A financial buyer, like a private equity firm, will typically have staff that are hired to review inbound investments and investment opportunities, and they'll have clearly defined criteria for the types of companies that they're looking to invest in. They'll have a very strict investment thesis that guides what types of companies they look at, what types of companies they invest in, because this is the strategy and the plan they've given to investors to raise third-party capital. Financial investors will focus on things like quantitative metrics, so revenue or profitability, being able to retain shareholders and management, being in a relevant industry segment that matches their experience, and how the business might fit with their existing portfolio. And then about strategic buyers on the next slide, even if they have a history of M&A, there may not be someone at that company whose job it is to review a potential acquisition, and they may not have set criteria for companies they're looking to purchase. So as an advisor, that means it may take a bit more work for us to find the right person at one of these industry buyers. We may end up contacting multiple parties or multiple individuals at a company to make sure we can find the person who is the correct internal champion for the acquisition opportunity. But when strategic buyers are looking at potential investments, they're really focusing on how that business will be accretive to their existing operations. This could be a new geography, as you can see on the screen here. It could be access to new customers, potentially new products that might be complementary to their existing portfolio, or access to new technologies or IP or talent. There are a number of different factors that the buyers will consider when it's assessing a potential transaction. And as an advisor, we need to do as much review as we can on our end to make sure that we can identify a fit between our client and the potential buyer. So when we're going through our buyers list, we want to make sure that we have a good reason to go to each buyer, and we can highlight the potential fit to every buyer to get them as excited as possible about the opportunity of acquiring our client. We really want to make sure that we're spending time on buyers where there's a clear angle for their investment, because that means there will likely be interest and motivation for them to move throughout the acquisition process. And on the next slide, we've outlined a selection of past deals that we've worked on in the manufacturing space. So this would represent deals that BDO's M&A team has advised on across Canada over the past few years. And I'm not going to walk through them in detail, but I will say that as a group, we've advised a number of manufacturers in a variety of industries. So it includes equipment manufacturers, auto and truck part manufacturers, plastic and packaging companies, manufacturers of a number of other products. And in our experience on all of these transactions, we've gotten to know the industries well. We have an idea of industry trends and valuation multiples. And in our experience in talking to buyers on past engagements, we've become familiar with a number of these potential buyers. If I haven't necessarily spoken to a buyer before, it's likely that Michael or Brian or another staff member has. So I believe that you'll be getting access to the deck afterwards, but we'd be happy to provide any additional context on any of these past credentials that we've highlighted here. And I think up next, I guess we'll have Jesus from Strategy and Value Creation to talk through creating value.
Thank you, Alex. Well, my name is Jesus Ballesteros, and I'm a partner in our Strategy and Value Creation practice, and I get to talk to you about value enhancement before a sale, which is an important part of the whole process. So the first thing that usually comes to mind after deciding to sell is, well, what can I do to maximize the value of my business? And there are a lot of things that need to come together for that to happen. And we've tried to capture all of them, or most of them at least, on this slide. So first of all, there needs to be an analysis of your options at the very high level, at least, or at an initial level. Is there an alignment between what your business does, what the market is looking for? It's important at this stage to understand what the M&A market is like when you're going out to market or plan to go out to market, to be able to understand what the thesis might be for a potential buyer. Value enhancement is, of course, the next component here, and I will talk more about this in my comments afterwards, but certainly preparing your business for sale and trying to maximize the performance of your business is important, which can be done in many different ways. Preparing for a deal properly can add value, and this involves doing your vendor due diligence, conducting a valuation, a formal valuation, and addressing some of those risks that might be out there that you might want to address before heading into a sale, to be able to eliminate any obstacles to a transaction. And then finally, I should mention tax planning. This is a big topic, and we're not going to talk about it too much today, but proper tax planning is important to also be able to maximize returns in a transaction, right? And this can be impacted by many factors, including legislation, as we all know from recent changes to our tax code. Now, all of this comes together to maximize returns. And these are things that take some time. So starting early usually pays dividends. Now, when talking specifically about value enhancement, a very intuitive way of looking at how you can improve the value of your business is by taking the EBITDA multiple method approach, right? This is one that we use very often here at BDO, and it is essentially one of the methods that are used to formally value your business, but it can be used as a framework to think about how you can improve the value of your business. As many of you, I'm sure, know, this approach essentially takes the EBITDA of your business, the earnings before interest, taxes, depreciation, and amortization, and then multiplies it times a multiple, which is a multiple that's assigned based on a bunch of different things, many of them market dependent, but also influenced by your own company's internal structure and performance and a whole bunch of other things to give you a sale price. And looking at your value in this way can actually help you address some of the areas where you might be able to increase value. On the EBITDA side, very intuitive, of course, here, if you look at revenues and you look at your costs, these are where you can find opportunities to improve, right? And when you think about multiples, then there's a whole bunch of things that we'll talk about in a sec. Now, when we talk about EBITDA improvement, this is where a lot of the work can happen in order to find both short-term opportunities for increasing value, but also some longer-term opportunities. And it starts by looking at your P&L, right? And just very simply looking at your revenues, first of all, understanding what is your performance in the market, looking at your products, looking at your customers, looking at your pricing, and trying to understand, well, are there things that I can do in the shorter or longer term to enhance any of these things to be able to increase my top line, and in that sense, increase my EBITDA as a result. So looking at revenue items is one way of getting to that. On the cost side, of course, you have the cost of goods sold, and that's essentially comes down to all of your costs involved with manufacturing, producing your what you sell. And that is where, of course, it's important to understand, well, are there opportunities for me to further improve the efficiency of my facilities, my manufacturing operations, my logistical operation, distribution, et cetera, to be able to squeeze more value out of that value chain and reduce those costs, which of course in turn will increase your EBITDA. So it really comes down to understanding what are the driving factors behind those costs, and are there opportunities to improve? And in this bucket, it's always important to ask yourself, well, are there opportunities to automate some processes, right, that are currently being done in a manual way to be able to reduce some of that cost in the production of your items, of your products? Now, of course, also on the cost bucket is all of the SG&A, right, the operating expenses, and that can be a significant chunk of cost, of course, for many of us. And that is also a place where you can find opportunities to increase your value, right? By looking at all of your cost buckets and identifying, are there costs that I could potentially reduce by looking at things differently, or potentially also by automating? You know, it is very common nowadays to look at the finance operation, for example, and look at ways to automate some manual processes. It's very common for many companies in the mid-market operate using Excel spreadsheets, right? And there's a lot of porting of information manually from one to another. And nowadays, with the new advancements in AI and RPA, robotic process automation, it is easy to add some automation there to some of these processes, which can yield improvements in efficiency and just reduce that cost and improve the EBITDA of your business. So on the cost piece, very important to look at what can be done. And then finally, I would also mention working capital. Taking a good look at your working capital and identifying opportunities to improve that can also yield returns when it comes to the value of your business, right? For example, asking yourself, is there a way to reduce my inventory even further, the inventory on hand? You know, is there a way to be able to tighten my cash conversion cycle so that I have less money tied up in that cash conversion cycle, and I'm able to use that money more productively? So always taking a look at working capital as part of the whole equation of trying to improve your EBITDA. So that takes care of one side of the equation. When we talk about multiples, which is the other side of this equation, there are lots of things that can be done here to influence that. While multiples are largely market-driven, they can be influenced, again, by certain things that you can do within your business. And on this slide, I provide an outline of 3 different buckets of things that you can do to influence that multiple. First of all, we have revenue and margin continuity. Something that buyers have told us time and time again is that they like businesses that have a clear path to growth and to continuity, in which the risks to the business are low. And many things actually obviously play a part in this continuity. For example, Are your customers diversified, right? Do you have good bargaining power? And can you credibly retain those customers into the future, right? Very important. So for example, do you have customer contracts in place, which obviously are stickier than just having verbal arrangements with them, right? Suppliers as well. Are you diversified on the supplier side? Do you have enough bargaining power with your suppliers? What's the quality of your relationships with suppliers? These are important things for continuity. And of course, also on the product side, how diversified are you? Are you very dependent on one or two products, or do you have a more diversified portfolio that can lower the risk? Sales and purchasing team effectiveness are a key element in this. When you have strong sales and purchasing teams that can operate relatively independently, that adds a lot of confidence, right, to buyers, because they know that the business can operate very much on its own without a lot of intervention from owners or from leadership. So having that effectiveness embedded can help with that continuity piece. And then finally, being clear on strategy. What are your goals? What is the outlook for the business? What is the reasonable expectation of growth that you can have for the business? And believe me, when you come to your buyers with a solid thesis on how you're planning to grow in the future, that goes a long way in enhancing the multiple for your business. In the middle here, in the middle section, we find business efficiency and effectiveness. And this is all about how you do things, how effective you are at your processes, how digitized, for example, is your business, right? And what kind of governance do you have in place? So looking at your HR processes, looking at your IT processes, ensuring that you have maximized your IT platforms. While you may not have the latest and greatest ERP or all the latest and greatest systems, making sure that you're using what you have as much as possible in an effective way does help in influencing a higher multiple, right? Because you are making the best use of the assets that you have there in place. And on the HR side, can't say enough about the importance of keeping an eye on your labor practices and how effective you are at retaining your people, and also showing that you have retained all of your key employees for a long time. Those are factors that buyers look at all the time, both financial and strategic buyers. They look at this all in every deal. They want to ensure that they have that labor continuity, right? And that they have good retention capabilities in the businesses that they acquire. And then finally, on the right-hand side, independency from owners. This is a very important consideration when we have a situation where the owners are looking to exit, right? They're very, of course, reasonably expected. A lot of owners are looking to exit, finally retire, be able to travel, do other things with that retirement nest that they've built over many years of hard work. And this is where it's very important, becomes important to embed independency from owners in the business, making sure that when those owners step away, whether it's a few months or maybe a year or two after the transaction happens, that the business continues to operate without hiccups. And this, of course, involves having good succession planning in place, making sure that the owners are supported by a strong leadership team that can take over when the time comes, and also making sure that you have good standardization of processes so that they're not very dependent on specific individuals and specifically from the owners. So the owners can step away, and for example, things like the signing of checks and the regular day-to-day do not get delayed as a result of that. And then, of course, any intercompany dynamics if there are multiple entities that are involved in the transaction, right? So these are all things that I certainly encourage you to think about in your businesses that might influence a higher multiple in order to enhance value. So as you can see, by looking at both EBITDA and multiples, when you act on both sides, you can end up with a higher valuation. Now, there is, of course, a benefit of starting early and working on this, right? The earlier, the better, because some of these opportunities do take time to implement. There are always things that you can do and opportunities you can capture within a few months, right? And that can be some low-hanging fruit, low-hanging opportunities there that you can go after. There's also some medium term, and then there's longer term stuff that you can do. And ultimately here, the idea is to try and maximize what you can do regardless of when you're going to sell, see what is it that you can do and try and maximize that. And of course, at the end of the day, we do always encourage that if you're thinking about selling, start early. Start a year or two at least in advance of the transaction, potentially even more, because at the end of the day, and this is an important consideration to keep in mind, is that buyers want to see that you have realized changes before you sell. So it's very different for you to make a change and then go to market and claim that a change will benefit or will yield a certain benefit versus actually demonstrating that you've made the change, you've realized the benefit, and you're now operating at a better level. In the second scenario, you've demonstrated that you can actually have better performance, and the buyer will obviously reward that with a higher multiple or a higher valuation. So it's always ideal to start earlier and try and implement some of the changes in advance, so you can show some of that enhanced performance prior to going into a sale for at least 6 months or potentially even longer than that. So at the end of the day, when you think about what are the critical success factors to be able to enhance value prior to sale, well, it is very important to identify those opportunities. Look at both the EBITDA and the multiples, and look at what are the things that you can do. What are those levers that you can pull to be able to enact some changes? Define your goals, define some objectives, leverage data as much as possible. Try and use data to inform your decision making and involve all of your key stakeholders, all of your key leaders in the company. Make sure they're involved in improving the value of your company. Implementation is key, making sure you follow through, that you apply proper project management practices and get things done. At the end of the day, this is what really ultimately matters. Monitoring your performance, tracking results, you can then later present that to potential buyers, demonstrate that you've made some changes and and show the before and after, which can be very powerful in getting good responses from potential buyers. And then, as I mentioned earlier, trying to realize that value as much as possible before you go out to sell, right? So it's demonstrating that you've already captured some of that value, show the EBITDA uplift, which will, of course, times a higher multiple, just compound the value of your business, which is at the end of the day what you'd like to see here, right? So making sure that you have all these three things in place is ultimately very important for value enhancement. And then one final note on the actual formal valuation of your business. That really only happens until the time of a sale, right? So all the value enhancement work happens, a year or two or even before a sale. But then once you get closer to that, once you're doing your vendor due diligence, that is when you would then perform a formal valuation of the business using not only an EBITDA multiple approach, but using others like a discount cash flow approach. And at that point, that's when all the work that you've done in enhancing the value of your business can be leveraged, because you've addressed a lot of the risks and you will have already a plan in mind for how to grow. And these are elements that all go into the formal valuation of your business, right? Because the more clarity you have of the future, the better that valuation will be, right? And at the end of the day, the way the formal valuation works is that you'll be provided with a range of how much your business is worth based on a range of different methods and a range of in a number of different factors. And that becomes that target value that you're going to be expecting to get from your potential buyers. But that's, again, at the very end of this process, right? The real work comes in what I've described over the last 15 minutes, is working on enhancing your value so that by the time you do the formal valuation of your business as part of the vendor diligence package, that you can demonstrate you can attain a higher valuation in the market. And with that, I think I can pass it over to Matthew to go over some Q&A. I hope this presentation in its entirety was helpful in giving you a picture of our M&A process and all the different components that are part of that. And again, I would like to emphasize the importance of starting early, thinking about this ahead of time so that you can maximize the value of your business. Matthew?
Jesus, thank you very much. Why don't I ask all of the presenters to come back on? You can stick on to Jesus. So we got a few questions come in over the chat during a couple of you guys answered as you went along, which I'm not surprised at all. But why don't we start with one that came in here earlier on in the session, actually. And I've got a bunch of them here. And if others want to ask questions on stuff that you want more clarity on, please just put it in the Q&A chat and we'll get to it during this part of the session. So open question, doesn't really matter where we go to. Michael, maybe I'll start with you, but maybe someone else be better off. But do you see buyers change the transition plan once the process is closed?
Generally not. I find buyers are fairly open in terms of their plans as they work through the diligence process. So before they're closing, they're doing very detailed diligence, but also simultaneously doing a lot of work around the integration planning, the plan for the next year, things of that nature. And so those plans are really well thought out in advance of closing, and that then informs the business and management in terms of how they operate the year after the acquisition and go forward. Obviously, things change, nothing's static, and so things need to adjust from time to time. From an employee or management perspective, sometimes there's some changes that happen that just doesn't gel with people, and so sometimes there's some changes made in terms of the management team, or even often if the owner is staying on. It doesn't happen always. Certainly a small percentage of transactions that we work on, but sometimes the owner is just not up for being an employee going forward, and there's a transition. I'd say for most owners, there's a defined transition period. Usually it's fairly short, 3 to 6 months. And then the owner transitions out. In some instances, the owner is key to the business, and there's more longer term play for that owner. But it's a very different environment sometimes of being an owner versus an employee, and sometimes that doesn't gel. So sometimes that causes a change in direction.
Great. Anyone else want to add in on that, or should I go to the next one?
Well, just to add quickly that usually the smarter buyers, and we see them do this all the time, they plan the integration in advance, and they often put in place certain measures to try and retain the top talent, and that's a smart move, right? Because buyers that have done this many times, they know that the business relies on specific people, and they usually work with the target to try and put in place some sort of retention approach, so that when the transaction closes, those people are presented very quickly with a package to try and retain them, right? And that is very important to ensure the continuity of the business. And as I mentioned in my piece, if there is good succession planning as part of the work that is being done prior to a sale, then those leaders will be there ready to take over, and they will be excited, hopefully, by new ownership, and will be responsive to any kind of retention package that is put in front of them, right? To be able to guarantee that continuity once the owners step away.
Yeah,
Great.
that's well said, Jesus.
So maybe a kind of a connected question then to that one came in is at what time do you allow employees or other key people to know your business is for sale? So what's the timing for bringing those critical people into the loop, and then maybe others more generally? Do you have some advice for people around that?
Sure, I can handle
Whoever,
that.
Okay.
Nippon, maybe if you can go to the process slide, I can certainly talk to it at different parts of the process. Generally, when we're working on a sale process, at the preparation stage as well as the marketing stage, it is a very small group of people that are in the know. Often it might just be the owner that we're working with if they have access to the information that we need to prepare the information package. Sometimes we bring in the controller, the CFO at that point in time if we do need that access to information, but it's really a small group of folks at the initial stage. And so we try not to include a broader group of employees at the start because of that need for confidentiality. We haven't made a decision to sell the business. Ultimately, we don't know who the buyer is, if there'll be a buyer that surfaces that concludes a transaction. And so naturally, if it gets out or you include employees early on, they'll have these questions that we just can't answer. And that adds uncertainty, anxiety. People might be more amenable to then move roles into another organization, and that is never helpful in terms of a sale process. As Jesus just mentioned, people are key to the business and key to the transition and key to the value of the business, and so that's a key element. So early on, first couple phases, like it's just very limited for those reasons. Once we know that there's offers that are in an acceptable range and we go into kind of detailed diligence, then it's with a smaller group of those buyers, so qualified buyers, maybe it's 4 or 5 or 6 buyers. As part of their diligence, they're going to want to meet the management team. So at that point, now that we've got qualified buyers that are interested in the business, we do open it up a little bit to key management members who'll be involved in the process. Again, it's reiterated with the management team that needs to be confidential. To Jesus's point, their strategies in terms of retention bonuses or transaction bonuses, they're sometimes paid to management team members to compensate them for working through the deal process and ultimately being on board through that process. And then ultimately, there isn't an announcement or a broader communication with the employee group until there's a definitive agreement that's signed, either by way of an asset purchase agreement or a share purchase agreement that's binding in nature. So through most of this process, the discussions are non-binding, but we really want to know that a deal's been had and will close or has closed before you have conversations with the employee group. There will be a communication plan between both the seller and the buyer that's coordinated. There's messaging. And so all of that is to make sure that the employees know what's happening at that point. It's to give confidence in terms of what the plan is, be able to answer their questions around, do I have a job? Who do I report to? Does my bonus change? Do my benefits change? You know, what are the long-term opportunities with this new organization? All of those natural things have to be answered and prepared in advance. And so that's typically how it flows. Like I said, sometimes earlier on in the process, there might be leaks of information. The general response to employees is that, we haven't made a decision to sell, and once we do, we'll let you know. But that's in fact true. Like we may be exploring discussions, having discussions, but no decision is ultimately done until there's a binding agreement in place. And after decades of working in this space, you never know, anything can happen during a deal process. We try to get that done as quickly as possible, but during a process, anything can happen that might not even be in our control. It might be something to do with the buyer, something that's changed within the buyer that we just have no control over. And so until it's done, we don't really have communications with the employees generally as a strategy. There might be cases where we change that strategy, but generally that's how we manage it.
Excellent. Thanks, Michael. Next one. At the beginning of the presentation, someone mentioned, maybe Michael, you mentioned that U.S. invested capital is at an 8-year high. And sorry, I can't remember who said this now. Can you touch on the impact of non-Canadian buyers and the benefit of seeking a Canadian buyer? How do Canadian offers compare to those of U.S./global buyers?
Yeah,
So
that's a
whoever,
great
Michael, if that's
question.
you, yeah, okay.
Yeah, I can comment on it, and then
Okay.
maybe Brian can add to it. The US is an important source of capital and buyers for our transactions. About a quarter of our businesses go to US buyers. So it's a natural market, well capitalized, and a lot of active buyers. Businesses have to be generally of a certain size to attract cross-border investment. I'd say generally you need to be at least 5 million of EBITDA. Buyers want to ensure that whatever they're buying will have an impact in terms of their business, and generally businesses in the US are of some scale. And so to attract that capital, generally need to be about 5 million of EBITDA. On a more global scale, overseas buyers, I'd suggest you have to be closer to 10 million to get that attractiveness. Again, it's just more investment in terms of time, understanding the market, having impact in terms of the buyer's financials. So it needs to be of some size to attract those different types of buyers. The US folks generally, and I'll make some generalizations here, are use more debt to finance their transactions, higher leverage. They're more comfortable with that, and as a result, are higher price or higher valuations as a result of that. Typically, as well, they have synergies available to them with businesses in the US that can create scale in terms of accessing the US market, accessing their channels, things of that nature that Canadian buyer may not have. And so those are a couple of characteristics that may lead a US buyer to be able to pay more for a transaction. But that's a few things that we would typically see. But Brian, what's your perspective?
Yeah, I guess I would add, in terms of US buyers, they're not afraid of competing, which is another reason they pay more. And they generally can move a diligence process along faster. That might be a cultural factor, not sure, but they know how to get things done. Sometimes there's a concern about, what are they going to do with this business when they own it? Is it going to get consolidated? Generally, particularly in the lower mid, in the lower mid market, if the business is well established, and they're paying a high goodwill premium, they're going to operate that business as a standalone entity, and they're going to leave it in place. So there are a lot of good reasons to be open to dealing with particularly US buyers. European buyers, they tend to be more cautious, so they'd be at the other end of the spectrum. So the Canadian buyer would be maybe in the middle in terms of their approach and timing. A little more cautious, take a lot more time sometimes. And Europeans take a lot of vacations, and that can actually interfere with a due diligence process. And they seem to have more layers of approval, so their approval process can be a lot more elaborate. But they tend to be generally good to deal with and very honorable. So there's less of a risk of maybe retrading and dealing with that kind of situation in a negotiation. Our philosophy is to go to all the logical parties at the same time. So we like to have American buyers in our processes. If it makes sense, we'll have Europeans. It really depends on the size. And then we'll certainly try to get in front of all of the Canadian buyers that we identify. So
Great, thanks, Brian. Alex, you've been awfully quiet, so I'm going to pick on you now, or maybe I'll try to pick on you and we'll see how it goes. So we have two kind of similar type questions, and hoping you can help us out here. So the two questions are, how does customer concentration relationships affect the sale of my business? And then again, kind of on the same page, what are the range of multipliers you expect to see from industry-specific manufacturers such as automotive or aerospace, where the concentration is much greater? Can you help out there?
Yeah. I think for customer concentration and customer relationships, I think that will really impact the multiples that a buyer would pay. So when you're looking at multiples, that's a reflection of the growth opportunities and the risks involved in the business, and how the buyer is assessing the company, because you're applying that multiple to your profits, your EBITDA. And if there is something like significant customer concentration, that may be perceived as higher risk because your company may be relying on fewer customers. That theoretically could cause a bit of a lower multiple, but there are a number of factors. It'll depend on the industry. If it's a much more consolidated industry and there are fewer customers to provide to, that's very different than being in a much larger industry with a number of customers, but you're reliant on just a couple. Again, if you also think about the customer relationships and where those lie in the company. So if the customer relationships are all really with the seller, that's a lot more reliant on the person who is looking to transition out of the business. So that would be a bit more risk than having those relationships kind of spread out throughout the industry or throughout the company with multiple members of management. I think having strong customer relationships, having long-term contracts, those are things that are of value. Those can drive value in a multiple and in a process. But in terms of actual multiples, it's hard to state specifically what multiples will be, because
Sure.
there are a number of factors that will apply for valuation. Obviously the business itself, but also industry dynamics, timing of the market. There are a number of factors that could apply. I think, as part of our work with clients before we take on an actual engagement, we do talk through potential valuation multiples, what we have seen in the past on similar clients, what we've seen in the market right now, and we give our guidance to what we think a fair multiple would be, and we'd be happy to, I think, give more of that commentary on a more of a case-by-case basis offline.
Great. Thanks. Michael, were you going to add on?
If I could add, we encounter this in automotive and aerospace frequently. It's just the nature of those industries, where you're dealing with big OEMs that own a big percentage of the marketplace. And so we closed an automotive deal late last year where they were primarily supplying Honda. 80-85% of their sales would have been Honda related. We also did another aerospace defense business that was 65% General Dynamics. What will happen is that will limit then the buyers that are able to get comfortable with the risks of those customers. And so generally those businesses will then only go to strategic buyers that understand the risks, or maybe already selling into that client and have other touch points, relationships with that customer, and are used to operating in the space where you've got a few large OEMs that it's just the nature of their business, and they get comfortable with it. Those are definitely not businesses that go to financial buyers. So you can almost exclude all of those in a process of that nature unless they have an existing investment in the space. So does that then create a lower value? Because it depends. It certainly shrinks like I said, the addressable market in terms of buyers that you would go to. But if you have some good logical buyers there that are comfortable with those risks and there's synergies there, as long as we get a few buyers that are interested in competing in that offer, we could still see high multiples. But because the population of buyers that we're going to is less, generally we'd say that would trade at a lower multiple as a result, but never guaranteed.
I might add, Michael, the discount that a seller's worried about, you're going to get to a point where why would I sell? So how this usually, what we often see happen in how this plays out in the negotiation is the way the price is structured, and the focus is on retaining that customer and a positive outcome. And now that can also have a bearing on transition if owner is wrapped up in that relationship with the customer that represents a lot of risk if they were to depart. So it's a complicated subject. It will impact value, but the impact, I think, is going to flow through a structuring negotiation. And that's a polite way of saying, look, some of your purchase price is probably going to be deferred until we know we can hold on to this customer we close. Yeah. And we'd be happy to talk to you about this offline, as Alex said. It's a complicated subject and it's hard to address in sound bites. So.
Yeah. At the same time, though, I think it's important to mention that some of you that are listening to this may be very key suppliers to some of these very large customers. So it's in the very best interest of those big customers to be able to retain your company as a supplier. So that becomes also potentially something that influences the valuation. And finally, from a transition standpoint, when you have large customers like the ones we've been talking about, then they also become a very important stakeholder in terms of when to communicate and what to communicate, because it sometimes happens that the contracts that you have in place with these customers may have a clause saying that they have to approve any sale of your company, right? Because they're so strategic for them, because you are so strategic for them. So these are also some other considerations that need to be taken into account when you have large customers in the picture, right? That they become important stakeholders in the transaction, right? Given their vested interest in your continuity as a business, right?
I've been told we have 3 minutes left, including just trying to do some concluding remarks. But there's one question in here that I did want to get to. And so maybe really quickly, I'm not sure who's going to answer it. Maybe Michael, I keep coming back to you to start with, but on tax implications. So could you talk a little bit, you talked a lot about buyers from different places. Can you talk about tax implications of buyers from different places? And maybe a quick comment too on the ongoing discussion on the capital gains tax changes in Canada and how that might impact purchasing or selling in the next little bit. Really quickly, is that really easy, right? So you should be able to do it.
Yeah, really easy one right at the end. Thanks, Matthew. But generally, we go to market with the ideal tax structure for our client and say, this is what we're prepared to transact on. And we guide buyers to that as the preferable transaction structure. And that's part of leveraging that process. Buyers may inevitably want to restructure a little bit of the business before closing, which generally we're amenable to, so long as it doesn't impair our clients and sellers' expectations. So an international buyer may set up a new company in Canada to effect the acquisition. And so there might be some of that pre-closing work that's done, but generally doesn't impact our client. One diligence issue from a tax perspective that I get into quite a bit is if you're selling product into the US, buyers, particularly American buyers, have been bringing this issue up in terms of sales tax in the US, in each of the states and jurisdictions in the US. Some clients aren't doing what they need to do from a US tax state tax perspective, can be very costly during a transaction. So one of the things that we'd want to review and prep in advance, it's something that we can help with, but for many manufacturing businesses, it becomes a big diligence issue. So something I just wanted to highlight as well.
Great. All right. We've got literally 1 minute. So maybe let's do a quick east to west here. Brian, with you, Alex, Jesse, or Jesus, sorry, and then back to you, Michael, for very last concluding comments, but like 10 seconds each. So any last comments, Brian?
Most important transaction you're ever going to take place in your life, prepare. Don't rush into it. If you do, you might not get to the right results, and it'll be a lot more stressful.
And get the right advice from the right people, right, Brian? Alex?
I was going to emphasize the importance of making sure that your advisors and everyone that's working to help you through the transaction are on the same page as you. So make sure you know what your goals are. Your goals may change, but make sure that everyone who is helping you is working towards the right goal and helping you achieve the end result that you want.
Great. Jesus?
I would say start as early as you can and focus on people, focus on building that team on kind of underneath the ownership so that team can carry on the business forward.
And Michael?
Prepare. Preparedness will make the process so much easier, simpler for everyone, and ultimately result in a higher price. So partner with someone that's experienced who can help you prepare. That's really the key for success.
Well, thank you, everyone. The panelists, obviously, thank you. The team at BDO, to the team at CME who helped pull this together. Thank you very much, as always. And to our members and BDO clients who are on the call, or if you're not our members or BDO clients, please do reach out to us. All of us are here to help you in this one of the more exciting times probably in your careers as you're looking to buy or sell something. So thank you again for joining us today. We will send around this recording and all the content in it. And of course, if you have any follow-up questions, because there were a few we didn't get to, please do not hesitate to reach out to us. Talking is free. It's easy to reach out to us and we'll provide some advice to you and then see where things go to help you out. So thank you again. Thanks Team BDO and CME. Have a wonderful day.
Thank you, Matthew. Thank you, everyone.
Thank you all. Bye-bye.
Cheers.